Welcome back to the channel, ladies and gentlemen, and welcome back to Free America. The only thing in America that seems to be free these days, considering inflation is almost 9%, is your ability to watch this channel and watch these videos for free and invest in financial markets with very little upfront costs. So hopefully you guys are taking advantage of that and all of the fire sales that are out there. But we need to talk about what is going to happen in this upcoming week, because we have the FOMC minutes and we have a lot of other data that is coming out. And as you guys do know, the markets are going to trade off of data. So there's a lot of key points we need to discuss here in this video. Hit the like button and subscribe to the channel. Help push this video out to as many people as possible. Thank you guys for doing that. And let's get straight to this information. Happy 4th of July weekend for everybody watching. So like you guys probably already know, the stock market is not open for trading on Monday because it is the 4th of July. So go ahead and enjoy yourselves. But coming on Tuesday, you don't have anything too crazy as far as data. You do have factory orders month over month for May. That comes out at 10 in the morning, and I'm sure that will move the markets given how sensitive the markets are going to be to economic data. Now on Wednesday, you actually have ISM non-manufacturing PMI for June, JOLTS job openings for May, but the holy grail of this week's catalyst is the FOMC minutes, and that comes out at 2 p.m. and this is essentially the transcript from the last meeting, and it will give investors, markets, more clarity on why the Fed actually decided to go with 75 basis points. If they were discussing what the markets were pricing in, if they were looking ahead at another data point that we aren't quite paying attention to that led them to make that decision, we're going to get all of that information. So it will give the markets a little bit more clarity on why we got that 75 basis point rate hike. It's basically the transcript of what was said at the Fed meeting. It might give us a glimpse into what to expect at the next Fed meeting. So that's why that is so important. It usually does move the markets in a pretty big way, and it will be the main headline coming on Wednesday. And then on Thursday, you do have ADP employment change for June, Canada balance of trade for May, and the United States balance of trade for May. And this could actually be important this time around as well, because the balance of trade, that is one of the main segments that makes up GDP. So if our trade deficit was really bad, it affects GDP, and it will give us again a closer glimpse into what to expect for overall GDP. And we're expecting a negative $87.1 billion essentially balance of trade deficit. So that will be important to see exactly what that number comes in at. If it's much higher, that's not going to be a good thing. Now on Friday, you do have non-farm payrolls for June, unemployment rate for June, participation rate, average hourly earnings year over year, month over month, non-farm payrolls, all of this unemployment and employment data that the markets are going to pay very close attention to, because it's very unusual to have unemployment this low and go into a recession. So that's the main argument for people and the main reason why the Fed is raising rates, but it's mainly the big reason why people are saying no, there's no way we go into recession during 2022, because unemployment is so low. If that starts to tick up, it could be a bullish thing, because maybe the Fed won't raise rates as aggressively, because that's, after all, one of their two mandates is maximum employment and price stability. So it's going to be a teeter-totter kind of game in the stock market between the unemployment rate and what the Fed is going to do. It's like playing chicken. Which one is going to break first, unemployment or the Fed? So that's why that will be so important. Consumer credit change for May, that could also be very important. Wholesale inventories coming out at 10 a.m. on Friday. So that is what we have for this week. FOMC minutes, unemployment data that comes out, ISM manufacturing, jobless claims or JOLTS job openings. All of this will be very, very important. You do have Fed Williams as well, 9 a.m. on Wednesday. So those are going to be major market moving catalysts. Any data that we get that shows if we're heading into a recession or potentially not heading into a recession is going to be bullish or bearish for the markets. Obviously, recession seems to be a pretty bearish thing, but if we do head into recession, faster than not, the Fed will be able to pivot and not raise rates as aggressively, because unemployment at that point would start to tick up. Inflation would come down due to deflation during a recession. So there's that. And CNBC, good old CNBC, just confirming the same thing I just said. Recession fears flare in June. Jobs report looms as jittery markets ahead into third quarter. And yes, starting on Tuesday, that is the first day of the third quarter, so you might still see some portfolio rebalancing, and that could give us a little bit of a bullish pull to the markets. As you guys do know, the last trading day of Q2, we were positive 1.06% to end out Friday, and I do think it's possible we get a move, you know, back again to the upside, and then you do come down. Ultimately, if you guys have not watched my last video, go ahead and check that out, talking about, hey, you know, the stock market's probably going to fall and hit those lows end of July, midway through August, because you have the advanced estimates for GDP on July 28th. The day before that, on the 27th, you have the Fed raising rates, and during those days, during that time period, you are also going to get earnings from the largest companies in the world: Apple's, Amazon's, Google's, Nvidia's, Tesla's, and that is what is going to move the markets, because that is a fundamental change. And as we do know, the markets will always in the end revert back to fundamentals. So just because the price is going down on a lot of these stocks, but the fundamentals are actually getting much better, well, that is your buying opportunity, and that's why you want to take full advantage of this, because, hey, prices are coming down, fundamentals are getting stronger at a lot of companies that we do invest in. So there is that. That's really what we have to contend with in this upcoming week. The job report, I just want to point this out as well. Economists expect that employers created 250,000 jobs in June, less than 390,000 added in May, according to Dow Jones. And in quotes, "I think the market is caught between two narratives," said one strategist. Quote, "I don't know if it wants good news or bad news. At first, the hot economic news was bad because the Fed could go another 75 basis points and keep going, but now the market wants softer news. But is the landing going to be soft or hard? It's like threading the needle right now." And that's the best way to put it. It's like good data is bad, bad data is good, but to a certain extent, it's all bad data when it comes down to it, and the Fed is not going to stop raising rates. We honestly need to see the war in Ukraine end. We need to see energy prices come down in a big way, and that would definitely help out with what the Fed is trying to accomplish. So you guys have that for July 27th. Markets are expecting a 75 basis point rate hike. That would put the interest rate in between 2.25 to 2.5%. So that's going to be key. There's only about a 13.8% chance we only get a 50 basis point rate hike. That would put the target range in between 2 and 2.25%. So there is that. We have 3 weeks, 2 days, 22 hours, and 42 minutes until the next Fed rate decision. The other thing that I want to watch for in this upcoming week is going to be the margin debt data that should be coming out for June. And I think that's going to be very important, because if the margin debt is still really, really high, or even possibly going up from here, that's going to signal maybe we can get an even bigger flush out move to the downside. Also, the reverse repo markets. This is pretty important in my personal opinion, just because it's showing you how much money is actually locked up that is not being used in equity markets. So the higher the reverse treasury goes, you know, less money people are spending on stocks. That's why you can see once the market started to falter, call it halfway through 2021, the reverse repo market started to climb up, because this is essentially banks. Actually 108 counterparties on Friday took the reverse repo, and you get 1.55% just overnight for keeping your money in the reverse repo program. And this is about 10% of the M2 money supply, the total dollars that are in circulation, and this is the M2 money supply. So it's a lot of money that is sitting in reverse repo markets, over $2 trillion. We only have about $21 trillion in actual circulation. So keep all that in mind. I think it will be important data points to pay very close attention to. And as we reported in the last video, the Atlanta Fed GDP tracker is now predicting a 2.1% decline in GDP for Q2. That would mean a technical recession. Well, we are already in one. This cratered last week due to a couple key data points. that did come out on Thursday and Friday, including the ISM manufacturing PMI that basically showed the employment change, behind the scenes is not looking so good. And then the personal savings rates and personal spending rates did decline yet again, almost going into negative territory. So that's what brought the GDP estimate from a positive 0.3% to a negative 2.1% last week. Markets kind of brushed it off, but I think we'll start to get more fear about this heading into the next Fed meeting, and then ultimately the advanced estimates for GDP, which comes out July 28th. So that is pretty much going to be all for this video. That is what we have in store. If I were to imagine, we could see a pretty big move in the overall markets here for this coming week. I mean, from where we're currently at, a 5% move to the upside would put us back to about $400 on the S&P 500. That's kind of what I expect for a bullish case scenario. For a bearish case, a 5% decline would put us back to pretty much our 2022 lows, around 361, 362 on the S&P. So I think give or take 5% is kind of what we're looking at for this week. And then the big weeks come the end of July and in August. That's when shit really will hit the fan, in my personal opinion. So that is pretty much it. We don't have anything as far as real earnings for this week. You do have WD-40, you have Levi's, and that's pretty much it coming out on Thursday. That's not going to move the markets in a big way. It might show consumer demand on Levi's part, but I don't expect anything too crazy. So that is it. Thank you guys for watching. Hit the like button and subscribe to the channel if you guys found value out of the video. Nonetheless, you guys enjoy your weekends. I will see you in the next one.